If you're not confused, you're not paying attention. There are a lot of cross currents going on right now. So they were talking, stock market, not at all-time highs, but still quite close to them, right? A lot of exuberance still in the minds of investors, whether you're in stocks, whether you're in gold, whether you're in Bitcoin. And obviously those are all assets that people here are abuzz with. But then there's also a lot of macro data that, is not looking so great. Certainly a lot of data that the consumer continues to look weary. We're certainly seeing softness in everything from retail sales to, some of the employment data. We've just seen continuing claims come in at the highest they've been in a number of years at this point. So what's interesting is right before I came here, a gentleman stopped me in the hallway, and he runs a business that sells snowmobiles and ski-doos and motorbikes. And he said that his consumer sales really dropped off at the point where people are now basically bringing back their toys and trying to sell them back to his company at fire sale prices. And a lot of times he says, even though we pay them the going market rate for these things, they're still underwater given the loan that they have, on the vehicle. And his business really is, one of the leading indicators for how the consumer's doing, because those products are they're the epitome of the toy that you just don't need. It's a totally fun toy, but there's nothing essential about it. And kind of like RV sales to a certain extent. Those as well have really fallen off since the COVID highs.
George Gammon discusses historical patterns of rate cutting cycles by the Federal Reserve, comparing past instances like 2007 to 2008 with current trends in 2024. He highlights how these cycles often produce unexpected outcomes, such as rising inflation despite rate cuts. He predicts a potential global economic slowdown or recession in 2025, driven by factors like declining oil demand, financial stress in China, and synchronized rate cuts by global central banks. Gammon emphasizes that economic narratives often repeat, but warns that outcomes can differ. He also touches on the strength of the U.S. dollar, global liquidity risks, and opportunities in assets like gold and oil during downturns.
This is when times are good. If you listen to Jerome Powell, this is still when the economy is strong, resilient, and robust, and jobs market has normalized. It really makes you think, what happens if we actually go into a recession here? How bad could it get? Main Street doesn't own a lot of stocks. So I think it's something like 93% of financial assets are owned by the top 10% of households. So to a large extent, Main Street hasn't been participating in this party in the markets. And honestly, I think Main Street just kind of told us how it feels economically. That was, I think, the number one reason behind the decisive victory that Donald Trump just had in the U.S. presidential election. People were pulling that lever based upon that age-old adage, are you feeling better than you did 4 years ago? And I think the vast majority of people said, no, I'm not. We need a change, right? So, it's interesting. Financial markets are, again, it's a party that relatively few are enjoying, and they really love narrative. And right now, the narrative is that everything is still great and getting better, but it doesn't take a lot of digging beneath the narrative to start seeing where the cracks lie. And if you talk to just the regular person out there on the street who's living their lives, they tell a very different story than a record S&P price, a $100,000 Bitcoin price, whatever. They've got a lot more real-world concerns to focus on. You're asking a great question about today's markets in general, right? Where depending on what valuation metric you look at, financial asset prices are at the most richly valued they've ever been, or they're extremely close to their historical extremes, right? So, it begs the question, there's a saying that trees don't grow to the sky, right? There's a point at which no matter how much fantastic magical thinking is put into the prices of these stocks, there's no amount of real world results that can justify that amount of hopium. And we might have, I'm not saying we have, but we might have just reached that peak with NVIDIA because the stock put in, I think, the best quarter any company of history has ever had, right? $35 billion in revenue in Q3. If you compare that to Q3 back in 2016 for NVIDIA, it's 26,000% higher, right? They blew through their revenue estimates the street had. They blew through their earnings estimates the street had. And yet, to your point, the stock is off since then. And I think we might be getting to that point where the tree is just realizing it can't grow any higher. But I think that's the danger where we are right now, right? And one of the analogies that I like to use is, Wall Street falls in love with narrative. It has recency bias. And so it expects what's been happening recently to keep happening going forward. It creates a little bit of a self-fulfilling momentum, right? And so, if your team wins the Super Bowl, you're really happy, right? If they start doing well the second season, you start getting excited. They win the Super Bowl again, you're elated, right? Now you're fully on that team's bandwagon, right? You're totally expecting them to win the Super Bowl the third year in a row. That almost never happens. Statistically, that almost never happens. But one, you usually fully invest in it, right? And even if they have a great year, maybe they make the playoffs, but they don't actually get the Super Bowl title, you leave feeling really disappointed, right? And I think we're getting to that point where investors are just mentally beginning to expect an amazing year in 2023 that nobody thought we were going to have. As you remember, coming at the very end of 2022 and 23, everybody thought we were going into recession, right? Everybody feared the worst. We had an amazing year in 2023, an even better year now here in 2024. Now everybody is thinking, okay, we're going to 2025. Right? Yeah, exactly. And Trump just got elected and is going to do all this stuff that's going to be pro-growth and it's going to be great for the economy. And so I think we're setting up ourselves up here for kind of like the NVIDIA stock. I'm very concerned that the boots on the ground results that we see over the next 12 months, I don't know how they can justify the valuations that we have. And if you look at people like John Hussman and those who look at the arc of history, when prices have reached these levels of valuations, they generally have returned a low or a negative average annual return for the next decade. So John Hussman's models, I think, have us pegged at, an annual negative 4% return for the S&P over the next 12 years. You might remember about a month and a half ago, Goldman Sachs came out with a similar warning that this was only 3% a year. But if we average 3% a year for the next 10 years, that's going to be highly disappointing to everybody who's gotten used to these large double-digit returns that we've been clocking the past couple of years. Let me first preface by saying, I don't know how you value Bitcoin. Yeah. So is this at the top? I don't know. I can tell you if you look at technical charts, it looks really overbought in the short term. So it would not surprise me. Well, I think at this point, hitting 100,000 is probably guaranteed because people like narratives. There's a psychological pull to a big round number like that. Wouldn't shock me at all if we hit it. But it wouldn't surprise me at all, too, if soon after, we see a relatively material pullback, at least in this price. How deep? I don't know, right? To your point about if we are near a top and what happens if it does, the role of a bull market is to, at its end, and I have no clue if we're near the end of it for Bitcoin, but at its end, its goal is to suck in every investor it can before the rug gets pulled, right? And what happens during those periods is the sense of FOMO becomes almost irresistible, right? And everybody piles in, and everybody who sat on the sidelines and said, I don't understand it, I don't feel comfortable getting in it, they start second guessing themselves, right? This is the famous Isaac Newton factor, right, during the Dutch tulip bubble where he got out at a good price, sat on the sidelines, then got suckered back in right before it corrected and lost a ton of money, right? So it's just human nature. And the problem is it's usually at the very end there, it's all retail money. And in many cases, it's the retail person who doesn't understand it, really doesn't have the money to gamble with, but gets to the point where they feel like, I just can't not be in here because everybody else I know is making the easy money through this. They pile in, the losses emerge, and these are the people who are least able to shoulder those losses, and they get hurt the most. And that's probably the thing I'm worrying about right now. I think the consumer is realizing two very important things. One is monetary policy matters, right? Beforehand, most people didn't care about it. I'm old enough to remember when Ron Paul ran for president for two different presidential cycles, and he would talk about things like the Fed and its impact on devaluing currency. And people just dismissed him as this crazy old crank, right? He's talking about the most boring topics in the world, right? Now, all of a sudden, your average consumer is saying, wait a minute, let's talk a little bit more about that because my dollar buys 30% less than it did back in January of 2020, right? All of a sudden, they're really realizing that monetary policy and how you treat your currency actually has, real world significance. The other thing that they're waking up to is, you know what? Like, no matter what the policy decision is, whether it's to, stimulate or rescue or raise interest rates or lower interest rates or do QE or do QT, it seems like no matter what policy is enacted, it really helps the people who already have money. And the rest of us are getting increasingly left behind. And I think you put those two things together, and I think it does explain, again, why Trump got in. But I think it also is shining a brighter light on the real divide in America and probably in places like Canada and other Western markets. I think is less between the left and the right, which, that's where the spotlight's been, is how partisan things have become, and they have. But I think the real worry dimension to look at is the haves versus the have-nots. I think that the wealthy with assets are getting further ahead faster than ever. And everybody who's left behind is beginning to wake up to the fact that, wait, we're increasingly getting the short end of the stick here. I personally fear we spend all our time wondering about when the financial corrective event is going to be. The real flashpoint might be a social one. So, when you talk about the markets, everybody that's invested in the market, I think right now is, as I said earlier, is expecting more of good times ahead. And one really important dynamic is, so Donald Trump just got elected with a clear mandate to come in and really disrupt things. disruptors, right? And if you look at his cabinet appointments, he's picking disruptors. He seems like he's going to be true to his word, right? So let's give him the benefit of the doubt. Let's say 4 years from now, he has dramatically shrunk the size of the government bureaucracy, made it a lot more efficient. He has deported millions of undocumented people here, many of them who are working under the table. And third, he's won the tariff wars. I wish him luck on all those. I would love for us to be on, in that future where all that work, we're beginning to enjoy the fruits of that work. I just don't see how you get from here to there without a lot of near-term pain in the economy from all that disruption, right? And I don't think that that is being communicated right now to the general American. In fact, I think most Americans are still being told, the happy promises, hey, elect me, I'm going to give you a beautiful economy. It's going to be better than it ever was, right? And yeah, it's good for the alcoholic to realize they've got a problem, stop drinking, go cold turkey. And at the end of that process, they're in a much better, much healthier place. But there's a really painful withdrawal process you got to go through. And we as a populace, I think, are going to have to take our harsh medicine to get to where we want to go. If I were advising Trump's team, I would say that's what I'd be messaging to everybody right now, telling them, look, I've inherited a real dysfunctional, steaming pile of an economy. And it's a good thing I'm here. But folks, we're all going to have to tighten our belts. We're all going to have to collectively shoulder, the pain it's going to take to make this transition well. And I think Americans would buy into that and support it. But right now, we're not being told that. And I think we're walking blind into what I think are those unavoidable disruptions. Inflation has proven stickier than Jerome Powell would like, right? And so that obviously argues against a slower pace of rate cuts, right? Also, too, it's kind of rare, right? Like when the economy is growing at 3% plus GDP, when the stock market's at all-time highs, right? When the labor market is fine, in his words, right? I have some doubts about the labor market data. These aren't conditions when a central bank is usually cutting, right? These are usually conditions when the central bank is tightening, right? It's a little bit worried about the economy getting a little too overheated, right? So the fact that the Fed is back to cutting and that it started with a big 50 basis point rate cut, it's a little bit of a historical anomaly, right? And sort of, one of two things is true. Either they are supremely confident that the trajectory is going to be down to 2% and that they feel like they can make these cuts, or they're potentially worried about something that they're not telling us, right? But inflation is going to be an obstacle for them. At this point, we'll have to see. I do think over the arc of time, they're going to have to cut, and they're going to have to cut for the reason you mentioned, which is the debt, right? At the end of the day, when the debt pile becomes too big, you get into this period called fiscal dominance, and I won't get too wonky on it here, but one of the aspects of fiscal dominance is the Fed actually has to abandon all its other mandates, or the central bank has to abandon all its other mandates, and its supreme mandate is we got to keep the debt serviceable, right? So they'll do everything they can to reduce the cost of the debt, as I'm sure many of the folks you've interviewed have talked about this past year. With the Fed rate hiking regime, the cost of our national debt, servicing it has ballooned, right, over $1 trillion this year. And so eventually that is going to be the 800-pound gorilla that the Fed is going to have to react to, which is, hey, we'd love to try to contain inflation. We'd love to try to keep, us at maximum employment. But when push comes to shove, we got to keep that debt service cost manageable enough that the government can function, the economy can function, and the banking system doesn't start falling apart. They will literally do whatever it takes. Like that's the whatever it takes moment.
George Gammon emphasizes that while economic patterns and narratives tend to repeat, the outcomes can be counterintuitive and unpredictable. He highlights the importance of studying history to understand potential scenarios, such as the possibility of a global recession in 2025, marked by disinflation, financial stress, and shifting asset values. His analysis suggests staying prepared for economic uncertainty and viewing downturns as opportunities for strategic investments, especially in assets like gold and oil over the long term.